The year was 2016. Carl Icahn, one of the most feared investors on Wall Street, sat in his Manhattan office staring at a screen. He'd lost $2 billion in one trade on a company everyone told him would fail, Netflix. He'd been shorting it for 5 years, convinced the business model was broken, convinced he was right. The market disagreed violently. Now pause for a second. If Carl Icahn, who's forgotten more about investing than most financial advisors will ever learn, if he can lose $2 billion on what seemed like a sure thing, what are the odds your 401k is sitting on a landmine right now? What's happening to your retirement account while you're watching this video? Quick legal note: nothing in this video is financial advice. I'm not your financial advisor. This is educational commentary based on historical case studies. Consult a licensed professional before making investment decisions. My name is Arthur Sterling. I've spent 15 years studying what separates retirees who thrive from those who survive on cat food and regret. And I'm about to show you a battlefield most people over 50 don't even know they're standing on. This video is not about getting rich. It's about not getting poor. By the end, you'll understand the 3 invisible mistakes that vaporize Carl Icahn's $2 billion and how to make sure they don't vaporize your next 20 years. This single decision has historically added hundreds of thousands of dollars to retirement portfolios over a 30-year period, according to Vanguard's research. So if you're over 50 and you have money in the market, any money, you need to hear this story. 1973, Sears, Roebuck and Company owned American retail. They weren't just a store, they were the store. If you wanted a refrigerator, a lawnmower, or a new suit, you went to Sears. Their stock was considered bulletproof. Widows owned it. Pension funds owned it. It was the Amazon of its era. 30 years later, bankruptcy, gone. Anyone who stayed loyal, who believed in the brand, who held through the decline because Sears will come back, lost everything. Meanwhile, Amazon, this weird internet bookstore nobody understood, became a $2 trillion giant. Here's why this matters to your money. Carl Icahn saw the future. He knew Sears was dying. He shorted the stock and made a fortune. But then he made the deadliest mistake in investing. He got cocky. He thought he could call the top on Netflix the same way he called the collapse Sears. He couldn't. And that's where our story begins. Meet Carl Icahn, the activist. This man didn't just invest, he waged war. Hostile takeover, boardroom battles. He'd buy 10% of a company, fire the CEO, and flip it for billions. In 2013, he looked at Netflix and saw the next blockbuster, a streaming company burning cash, drowning in debt, spending billions on original content that might flop. He went short, massively short, betting the stock would collapse. The stock was at $65. He was certain it would crash back to $20. Instead, it went to $650. Then kept climbing. Carl Icahn held that losing position for 5 years. 5 years of watching Netflix climb while his short bled him dry. That's what we call dead money with pain attached. By 2018, he'd lost $2 billion. Now Carl Icahn is not stupid. He's one of the greatest investors alive. So what happened? Mistake number 1, paradigm blindness. Carl Icahn grew up in the world of cable TV and DVD rentals. That was his mental model. He couldn't see that streaming wasn't replacing TV. It was becoming something entirely new. He fought the future instead of riding alongside it. Mistake number 2, ego override. Once he took the position, his identity became attached to being right. He wasn't analyzing data anymore. He was defending his reputation. That's not investing. That's pride with a price tag. Mistake number 3, capital destruction through conviction. He didn't just lose money. He lost time. 5 years. 5 years he could have spent compounding wealth and boring, unsexy index funds just went up. Opportunity cost is the silent killer of retirement portfolios. Now here's the question that should terrify you. How many of these mistakes are hiding in your portfolio right now? Let me show you two completely different playbooks. On one side, Icahn, the activist, the warrior, the man who thought he could outsmart the market. On the other side, Reed Hastings, CEO of Netflix, the man who built the future instead of trying to predict it. One lost $2 billion. The other created $200 billion in shareholder value. But here's the twist: neither strategy is right for you, because you and I, we're not billionaires. We don't have 20 years to recover from a bad bet. We don't have insider access or boardroom leverage. We're part-time investors up against full-time professionals. That's not a fair fight. So what do? After 50, you're not fighting the market. You're fighting four enemies. Enemy number one, time compression. You don't have 30 years to recover from a crash. If the market drops 40% when you're 55 and you panic and sell, you might never recover. The math doesn't forgive you anymore. Enemy number two, inflation, the silent thief. $1 million today will buy you $600,000 worth of goods in 20 years at 3% inflation. Your money is rotting. If you're not growing it, you're losing it. Enemy number three, taxation. Most people over 50 are sitting on a tax bomb they don't even see. Traditional IRAs and 401. You haven't paid taxes on that money yet. And in 2026, tax rates are scheduled to jump. Uncle Sam is coming. Enemy number four, cognitive decline. I've seen brilliant engineers, people who built careers on logic, make catastrophic financial decisions at 70 because their judgment slipped. If you don't automate your wealth strategy now while you're sharp, you're vulnerable. So how do you fight back? There are two paths. Only one survives. Path A, the Icahn path, the active trader. You pick stock. You time the market. You watch CNBC and think you can spot the next Amazon. Let me be brutally honest. Unless you're trading full-time with access to institutional research, real-time data, and emotional discipline most humans don't possess, you will lose to the professional. Not sometimes, almost always. Icahn trades full-time. He has armies of analysts, and he still lost $2 billion on one position. But you think you can do it as a hobby? The data is ugly. 90% of active traders underperform boring index funds over 10 years. That's not my opinion. That's Morningstar, Vanguard, and decades of research. Path B, the boring millionaire. You build a fortress. You automate. You let time do the heavy lifting. Here's what this looks like in practice. 60% of your money goes into a low-cost total market index fund. You own everything Apple, Microsoft, Netflix, companies that don't even exist yet. You're not betting on one horse. You're betting on the entire racetrack. 30% goes into bonds, investment grade, boring bonds. They won't make you rich, but they won't blow up either. They're your shock absorber when the market crash. 10% goes into TIPS, Treasury, inflation protected security. These are backed by the U.S. government to adjust with inflation, as secure as it gets within government-issued securities. You can buy them directly from the government's official platform, treasurydirect.gov. No middleman, no fees. Just Google Treasury Direct to verify the official site. Over the past century, this approach has averaged 8 to 10% annual return, though past performance never guarantees future results. It's not exciting. It won't make you feel like Gordon Gekko, but it works. Now let's be clear about the risk. This portfolio will drop during market crashes 2008, 2020, whenever the next one hits. If you panic and sell at the bottom, this strategy failed. It only works if you have the discipline to hold through fire. That's the price of admission. In 2008, this portfolio dropped 40%. Millions of people sold at the bottom, locked in losses, and never recovered. But everyone who stayed the course and held through 2011 recovered their losses and went on to new highs, assuming they didn't need to withdraw during the crash. The market doesn't reward brilliance. It rewards survival. Here's how you execute this in the next 48 hours. Step 1. Open your 401k statement. Look at your allocations. If you're holding individual stocks, sector funds, or anything with growth or aggressive in the name, ask yourself, why? Are you trying to beat the market, or are you trying to retire with dignity? Step 2. Consolidate into 3 buckets. Transfer your equity exposure to a low-cost index fund from a reputable provider. Vanguard, Fidelity, Schwab, whatever platform has the lowest expense ratio. I'm not endorsing a specific company, just the structure. Look for expense ratios under 0.1%. Move your bond allocation into a total bond market fund or individual investment grade bond. Add tips for inflation protection, 10% of your portfolio. Step 3. Automate rebalancing. Set your account to rebalance quarterly. When stocks surge, it automatically sells some and buys bond. When stocks crash, it does the opposite. You're buying low and selling high without thinking about it. This is how you remove emotion from the equation. Step 4. Address the 2026 tax bomb. If you have a traditional IRA or 4-0-1-K, you're sitting on deferred taxes. In 2026, the Tax Cuts and Jobs Act sunset. Rates go up. Talk to a fee-only fiduciary, not a commissioned advisor. A fiduciary who's legally required to act in your interest about Roth conversion. You pay taxes now at today's lower rate, and once that money is in a Roth, it grows tax-free under current law, one of the best wealth-building tools available today. Step 5. Build your inflation shield. If you're living on a fixed income pension, Social Security, you need a separate bucket that grows faster than inflation. That's your TIPS allocation, plus a small slice of real assets like commodities or real estate fund, not speculation protection. Here's what nobody tells you. Wealth preservation beats wealth creation. After you're 50. After 50, protecting what you have matters more than chasing home runs. Icahn didn't need that Netflix bet. He was already rich. He did it because he wanted to be right, and it cost him $2 billion. You don't have $2 billion to lose. You might have 200,000 or 500,000 or $1 million. And if you blow it, there's no comeback. You don't get a second act. The market will crash again. Inflation will eat your purchasing power. Taxes will come due. These aren't possibilities, they're certainties. The only question is, will you still be standing when the dust settles? Remember those 2 titans from the beginning? Icahn tried to beat the future. Hastings built it. Your portfolio can't beat the future either, but it can ride alongside it if you choose the right vehicle. You're standing at a crossroads. Door number 1. Keep doing what you're doing. Hope your stock picks work out. Hope you don't panic in the next crash. Hope inflation doesn't eat your lunch. Hope is not a strategy. Door number 2. Build the fortress. Automate the system. Remove your emotion. Let the math do the work. Most successful retirees I've studied chose boring over exciting. They chose survival over speculation. The data supports discipline, not drama. This isn't about beating the market. This is about protecting your independence, so you never have to ask your kids for money, so you never have to go back to work at 75, so you can leave something behind instead of becoming a burden. If you found this valuable, do 2 things. 1. Share this video with someone over 50 who still thinks they can time the market. It could help them avoid the kind of seven-figure mistakes that happen when emotion overrides strategy. 2. Subscribe, because in my next video, I'm breaking down the exact Roth conversion calculator you need to dodge the 2026 tax bomb step by step with real numbers. Icahn lost $2 billion because he couldn't admit he was wrong. Don't let pride cost you your retirement. Choose boring. Choose survival. Wealth quietly preserved. Dignity intact. Remember, this is education, not advice. Your financial situation is unique. Work with a fee-only fiduciary before making any changes to your portfolio. I'll see you in the next one.